So what happens when a Wall Street giant, one of the venerable gatekeepers of global finance, tries to shut the door on a financial revolution?
It's a fascinating question.
And that is the single intriguing question driving everything we're going to get into today. And I have to say, the stakes could not be higher.
It's not just an intriguing question, it's a live, high-stakes, multi-billion-dollar conflict unfolding right now in real time. We're literally watching a clash between radical financial innovation, embodied by Strategy, Inc., and the established traditional world, represented by MSCI.
Exactly. This is a battle over definition, over classification, and really, at the end of the day, over access to capital. On one side, you have Strategy, Inc., who, they proudly call themselves the world's first and largest corporate Bitcoin treasury company.
And they've earned that title. The amount of the asset they've aggregated is just staggering.
It really is. And on the other side, you have MSCI, this global index provider whose decisions, whose indices, are basically the plumbing that determines where trillions, literally trillions of dollars in passive investment money flows around the world.
And MSCI has just dropped a bomb. They've issued a formal proposal that acts as a direct financial threat to Strategy and really any company trying to follow that same playbook.
So what is the rule exactly?
The rule itself, on the surface, it seems kind of simple, but it is utterly devastating in its potential financial impact. They're proposing to exclude any company where digital assets make up 50% or more of its total assets.
50%.
50%. And they want to kick them out of their global investable market indexes, or GMI.
That 50% threshold, it's not just some arbitrary line in the sand. It feels like a financial kill switch aimed, squarely at Strategy, Inc.
It is. Our sources are indicating that if this goes through, this exclusion could trigger the immediate mandated liquidation of up to $2.8 billion of Strategy's common stock, MSTR.
$2.8 billion. How does that happen so fast?
Because the passive funds, the ETFs and mutual funds that track MSCI's indices, they have no choice. Their own internal charters require them to sell any holding that gets kicked out of the index, and they have to do it fast, sometimes within, say, 48 hours.
So it's not a choice. It's an automated crushing wave of selling pressure.
Exactly. And the ripple effect is huge. This action doesn't just hurt one stock. It cripples the entire digital asset treasury model. The whole date concept.
Right. The idea that a publicly traded company can use leverage and, sophisticated capital markets programs to accumulate and hold digital assets as its main treasury reserve.
That whole model is put in jeopardy.
So the core conflict, then, is all about classification. If a company holds half its assets in Bitcoin, what is it? Is Strategy, Inc. an innovative operating business that's just concentrating its treasury in a new asset class, sort of like an oil company holding oil reserves?
Right. Or is it what MSCI seems to be suggesting? And their rationale is driven by feedback from, and this is a direct quote, some market participants.
Some market participants. That's a little vague.
Very vague. But these participants seem to believe that this high concentration means they're essentially just passive investment funds wrapped in corporate clothing.
And that one little distinction, that classification, dictates everything.
It dictates whether they get to play in the global financial system. If MSCI decides they're a fund, they are out of the index universe and out of that, that $15 trillion river of passive investment money that tracks these benchmarks.
So that's the core dilemma we're diving into today. Is this a necessary, a prudent move by the old guard to protect investors from what they see as concentrated, volatile risk, or is it something else? Is it a calculated, almost protectionist shot fire to stifle innovation and exclude a powerful new sector that, frankly, threatens the old way of doing things?
And the outcome of that question dictates who gets to play in the global investment arena for the next decade. It's that big.
And I think it's important to note what we unpack today really impacts a huge ecosystem, including a lot of our listeners, especially those who've been following the unique financial architecture that Strategy has built.
Absolutely.
For those of you who have followed our deep dive series on Strategy, which we've sort of packaged up as an audio course on YouTube, we have gone over the whole 9 yards of their model. We've looked at the protection layers for investors in their preferred stocks, especially that STRC series.
We even covered that concept of hacking retirement with STRC.
Right, where we showed how small, consistent investors could potentially shape their own financial future using these stable, high-yield debt instruments that are linked to digital assets.
That was a powerful analysis. It
Yeah.
showed that a sustained investment, something like just $200 a week for 10 years, could theoretically compound into a financial position that supports a base income of $20,000 a year for 4 decades.
And potentially tax-free, depending on your jurisdiction and how it's structured. The whole thing was plausible because of the structural stability of their debt, specifically that massive cash reserve they've built.
And now, with this deep dive, we're exploring the latest and maybe the most serious existential threat to that very model financial exclusion by the gatekeepers.
Yeah, and this isn't some abstract fight. We're talking billions of dollars of immediate impact to Strategy's market cap out of the trillions that MSCI manages. It's market instability being introduced by a policy change.
And crucially, the risk goes way beyond just Strategy Inc. If MSCI succeeds in drawing this 50% line, it sets a really dangerous precedent. It could spark a chain reaction across all the other big index providers. Think S&P, Russell, FTSE.
So it could impair the future funding for every company that wants to become a digital asset treasury.
It puts a wall up in front of an entire burgeoning asset class. It's precedent setting. I'm Satosha.
And I'm Satoshi.
Okay.
You know, we're seeing a ton of engagement on the show, and it's so clear that you are all as fascinated by these deep dives as we are. You're demanding this level of detail, and it's that interaction that pushes us to go beyond the headline.
It really is.
And to keep producing this content, and importantly, to start making high-quality companion videos to help visualize some of this stuff, because explaining a liquidation waterfall without a diagram is tough.
It is. We are trying to unlock funding for a new Mosaic AI video editor by hitting 1,000 subscribers across all platforms. The tools really need to match the sophistication of the analysis we're trying to do.
So please, if you enjoy these discussions, subscribe on YouTube Music, Spotify, Apple Podcasts, wherever you listen. Every single subscription helps us bring more depth to complex topics, just like this one. Okay, so with the stakes set, let's break down the challenger. We need to really understand the financial fortress that Strategy Inc. has built before we can assess the damage this MSCI proposal might actually inflict.
Okay, let's start with their identity.
Yeah.
Strategy Inc., which used to be MicroStrategy, was founded way back in 1989. This isn't some, fly-by-night crypto startup. It's an established public company that made a very calculated, very revolutionary pivot.
A pivot to become the world's largest corporate Bitcoin treasury. And the scale is just, it's hard to wrap your head around. As of December 7th, 2025, their filings show they hold a massive 660,624 Bitcoin.
And their market cap was around $57 billion just a couple days after that. That scale is exactly why this has become such a systemically important debate.
But as we've talked about, it's not just the raw number of Bitcoin that defines them, it's the mechanism. It's how they do it. Strategy runs what the sources call a Bitcoin-backed corporate treasury and a really sophisticated capital markets program.
They call their core engine digital credit. And that's really the heart of their financial transformer model. Digital credit just means they systematically borrow fiat capital from traditional markets.
So things like convertible notes, preferred stock, term loans.
Exactly. They take that capital and use it to hoard Bitcoin. They're essentially leveraging the traditional system against the emerging one. The whole model is one massive institutional-scale arbitrage bet.
A bet that hinges on one fundamental assumption, that Bitcoin's long-term appreciation will massively and sustainably outpace the known fixed cost of servicing all that borrowed fiat capital.
They're deliberately taking on a high-leverage position because they have such deep conviction in the long-term adoption curve of the asset.
But a move like that requires a really finely tuned capital structure. The sources call it the menu of risk they offer to investors. Let's break that down.
Okay, so at the top of the stack, you have their common stock, MSTR. This is explicitly defined as a leveraged call option on Bitcoin.
What does that mean, a leveraged call option?
Because the company borrows money to buy more Bitcoin, the MSTR shareholders get amplified exposure. So if Bitcoin goes up 10%, Strategy stock, because of that leverage, might go up 15% or 20%.
But that leverage cuts both ways, I assume.
It absolutely works both ways on the downside. It's high risk, high reward. But Strategy's architecture doesn't stop there. Below that volatile equity, they've engineered the preferred stocks, STRC, STRF, and STRK.
And these are the digital credit instruments you mentioned.
Right, and they're designed for a totally different investor. Someone looking for high yield and stability, not high volatility.
This is where the financial architecture gets really clever. The whole system is designed to monetize the volatility of the equity of MSTR to secure the stability of their debt, like STRC.
Yes, the equity MSTR acts as the primary shock absorber. It attracts the high-risk, high-reward investors.
Which then feeds into that crucial mechanism, the ATM arbitrage. Strategy's main way of getting cash to meet its fixed obligations, like paying those preferred dividends, is by continuously raising capital, often through at-the-market or ATM equity offerings.
Exactly. They raise cash by selling MSTR common stock at a premium valuation relative to the actual Bitcoin value they hold.
And that premium, it exists because the market values their management team, their access to cheap capital, and the optionality of the whole leveraged structure.
And that premium is pure profit.
Yeah.
They take that cash profit, they stick it into that massive USD reserve, and that reserve is what backs the stability of the preferred stock and the debt. It's a dynamic machine that is totally dependent on continuous access to capital markets.
But wait, hang on. If the model is so reliant on high leverage and that, that optimistic MSTR premium, isn't MSCI's point kind of valid? If strategy fails to raise capital in a down market, they start to look a lot like a highly leveraged hedge fund that just blew up, regardless of their corporate structure.
That is the essential critical question, right? Strategy's defense is that while the asset is volatile, their operation is active. It's geared toward creating unique financial products, those debt instruments. A hedge fund just tries to outperform the market. Strategy is actively structuring and selling complex, regulated securities.
But if that MSTR premium collapses, which is exactly what MSCI's exclusion is designed to do, then that whole funding mechanism, the ATM arbitrage, just grinds to a halt.
It does, which brings us right to the gatekeeper's rule. If their access to that market is threatened, the whole machine slows down, and that jeopardizes the long-term ability to refill the cash fortress.
Okay, so let's examine the threat directly. MSCI is proposing to exclude any company with 50% or more of its assets in digital assets. It feels like a direct attack on the very balance sheet structure that Strategy pioneered.
It is. And their rationale, again, is based on this feedback from some market participants who believe these companies may exhibit characteristics similar to investment funds. And if you're a fund, you're out.
So Strategy obviously had to fight back. This is an existential threat.
They fought back hard. They sent a detailed, public open letter to the MSCI Equity Index Committee, and they launched a 5-point rebuttal challenging what they call the arbitrary and discriminatory nature of this whole proposal.
And that letter is basically the roadmap for our deep dive today.
It is.
Okay, so let's unpack their first point, which goes right at the core premise of MSCI's proposal, that DATs are operating businesses, not investment funds.
Right. Strategy argues that the entire proposal rests on a fundamental misclassification. They say they are not passive. They don't just buy Bitcoin and sit on it. They actively use it as the foundation of a very sophisticated capital structure.
So their core value isn't just, we hold Bitcoin and it goes up.
No. Their core value proposition is the design and the offering of those unique digital credit instruments.
Yeah.
The preferred stocks with different rates and seniorities. That's the business.
That seems like a really technical distinction, but one with huge legal and financial consequences. So how do they draw that line between what they do and what a typical investment fund does?
They use a really clear analogy. They compare their model to centuries-old financial models like banks or insurance companies. A bank takes in cheap capital, like savings deposits, and lends it out at a higher rate, capturing the spread. Strategy argues they do the same thing. They capture the spread between the known fixed cost of their debt and preferred stock and the potential long-term return on their underlying Bitcoin asset. They see it as active treasury management and financial engineering, not passive fund management.
And they have structural proof of this, right? They're not just saying they act like a company. Legally, they are a company.
Precisely. Strategy is a Delaware corporation. It's governed and taxed like any other conventional operating company, with a shareholder-elected board and corporate-level taxation. And crucially, they have none of the defining features of a fund.
Like what?
They offer no redemption rights. You can't call them up and ask for your share of the Bitcoin back. They charge no management fees to investors, unlike an ETF or a mutual fund. And they have no mandate to just track the Bitcoin price. They can pivot their strategy anytime. A fund can't do that.
So their argument is that investors are really buying Strategy's management team and their financial acumen, their ability to structure and service these complex securities, not just a proxy for Bitcoin.
And that management premium, the fact that MSTR consistently trades above the net asset value of its Bitcoin holdings, is the market's proof that it views them as an operating business.
Okay, that's a strong start. Now let's get to their second argument, which seems like it would be the most challenging one for MSCI to counter, that the 50% threshold is discriminatory, arbitrary, and basically unworkable.
This is where they really go on the offensive. They argue this 50% rule unfairly singles out digital assets, while completely ignoring similar or even more concentrated single asset holdings in almost every other major industry. They're calling out a clear double standard.
So what are the comparisons they use?
They give some really compelling examples. Why is a company like Strategy with 50% of its assets in Bitcoin suddenly a fund, while an oil and gas giant like ExxonMobil or BP, which holds massive proven reserves on its balance sheet, is still considered an industrial operating company?
That's a good point. Those reserves make up a huge percentage of their total asset value.
A huge percentage. Or timber companies like Weyerhaeuser, whose main assets are just timberlands. And the most direct comparison of all, real estate investment trusts, or REITs, like Simon Property Group, which invest almost exclusively in real estate.
And none of those are getting reclassified by MSCI as investment funds just because more than half their value is in one concentrated physical asset class.
Never. The discrimination seems to be aimed solely at the type of asset. It's only a problem if it's a digital asset.
And this threshold, they argue, also introduces this crippling instability into the index itself. They call it the whipsaw effect.
Yes, and this is a really critical technical detail that I think fundamentally undermines the 50% rule.
So explain the whipsaw effect. We know digital assets are volatile, so what happens when the price just hovers around that 50% boundary?
It creates chaos.
Yeah.
Strategy argues that if you have a fixed 50% threshold, DATs would constantly be whipsawing on and off the MSCI indices. Imagine the logistical nightmare.
Okay, so walk me through it.
Let's say Bitcoin drops 10% in a month. Suddenly, Strategy's digital assets fall below the 50% threshold, and they get included in the index. All the passive funds have to buy the stock. Then, if Bitcoin rallies 15% the next month, they're instantly excluded again, and all those funds have to sell.
And this is all happening because of external price movement that has nothing to do with the company's actual operations.
Exactly. It creates chaos for index composition. Passive funds would be forced to constantly rebalance and trade, driving up transaction costs for billions of dollars in assets just because the price of Bitcoin moved a little bit. It harms the reliability of the index as a stable benchmark.
And this feeds into another issue they raised, accounting chaos. How does something like accounting treatment make this even worse?
It creates a huge vulnerability for the rule's consistency. For instance, under some international accounting standards, like IFRS, companies often book digital assets at cost.
Meaning the price they paid for it, not its current market value.
Correct. So the balance sheet value of their Bitcoin could remain at the original purchase price, potentially keeping them under that 50% line for years, even if the asset's market value goes to the moon.
I see. So a European company that bought Bitcoin cheaply years ago would look totally compliant under IFRS rules.
Totally compliant.
Mm-hmm.
But a structurally identical U.S.-based company using U.S. GAAP has to use fair value accounting. They have to mark their Bitcoin to market every quarter. So if the price of Bitcoin doubles, that U.S. company is instantly forced over the 50% threshold and gets excluded, even though its business model is identical to the IFRS company.
Wow. So it's creating disparate treatment based purely on geography or which accounting rulebook you're using.
It is. And Strategy argues that this would just incentivize companies to play games, to migrate to international indices, or adopt certain accounting standards just to avoid the rule. It would force MSCI to become an accounting auditor, trying to figure out the true nature of assets under all these different evolving standards. The whole thing becomes administratively unsustainable.
Okay, let's move on to their third point, which really strikes at the core credibility of MSCI as an objective institution, that the proposal improperly injects policy judgments.
Right. Here, Strategy argues that MSCI is compromising its fundamental neutrality. MSCI markets itself as this neutral, objective provider whose indices simply reflect the evolution of the equity markets. They don't guide or judge them.
But by discriminating against one specific asset type, digital assets, the proposal basically turns MSCI into an arbiter of what's a good or bad investment.
They're passing judgment on a multi-trillion-dollar market. And Strategy's letter says this moves MSCI dangerously close to mixing social policy with sound finance.
What does that mean for the people who use the index?
It means if the index is no longer a neutral reflection of the market, but it now has a built-in judgment against a specific asset class, it undermines the reliability of that index for fiduciaries. Pension funds, asset managers, they rely on MSCI for unbiased market exposure. If MSCI starts filtering the market, that trust is broken.
And this filtering runs directly contrary to market reality. I mean, Bitcoin alone has a market cap of what, around $1.85 trillion now?
And strategy argues that excluding DATs structurally underrepresents that huge amount of economic activity. It directly contradicts MSCI's own stated goal of providing exhaustive coverage of the market. They believe an asset class that big cannot be ethically ignored by a major index provider that claims to be a mirror of global investment.
Okay, let's move to the fourth point, which connects this Wall Street decision to the bigger picture, to geopolitics and regulation. That the proposal conflicts with federal strategy and chills innovation.
This is a vital link because it raises the stakes beyond just finance to national interest. Strategy argues that this proposal runs directly counter to the U.S. government's stated bipartisan goal of promoting the growth and adoption of digital assets as a cornerstone of economic development and even national security.
They're saying the U.S. government wants to be a leader in this space.
Exactly. They cite specific high-level initiatives like promoting digital asset access for 401k, or even the proposals to establish a strategic Bitcoin reserve. These signals confirm that Washington sees digital assets as a critical technology, not some liability to be shunned.
So MSCI's proposal, which would result in that massive $2.8 billion liquidation of a U.S. company's stock, directly weakens the competitive position of American DATs.
It weakens them and effectively shuts them out of the passive investment universe, just as they're trying to scale.
And that damage, that chilling effect, it goes beyond just strategy, right?
It does. Strategy highlighted how the rule would instantly affect other new digital businesses, like Bitcoin miners. Miners routinely hold the Bitcoin they mine on their balance sheets as a treasury reserve.
Right. They wait for optimal prices to sell or use it as collateral.
But if they're afraid of being kicked out of an index, they might be incentivized to sell their mined Bitcoin the second it's generated, just to avoid hitting that 50% threshold.
So instead of being long-term holders that add stability to the ecosystem, the MSCI rule forces them to become instant liquidators.
Which distorts the market and restrains the development of the very technology that relies on these treasury holdings for capital and collateral.
You know, it reminds me of reading about the early days of technologies that everyone thought were too volatile, too specialized, until suddenly they were the backbone of the entire economy.
And that brings us back to the historical analogy Strategy drew in their letter. They used some really powerful examples to argue against what they called reactive short-sightedness.
What were some of those examples?
They compared themselves to companies like Standard Oil or AT&T, which were criticized for concentrating so heavily in oil drilling or telephone networks when those were brand new, seemingly unstable technologies. They also cited Intel and NVIDIA.
Right, who invested everything in semiconductors and GPUs decades ago. Critics could have said holding all those fabrication plants or all that IP was too much concentration in a single risky asset.
And the point is, early, concentrated investment in foundational technologies is often what's necessary for transformative economic growth. Gatekeepers shouldn't be passing judgment on whether a technology is good or bad before it has a chance to mature. Their job is to reflect the market, not dictate it.
That's a powerful narrative. So finally, Strategy's fifth point addresses the process itself. They just want to extend the consultation.
Yes, they urged MSCI to reject what they called a rushed and reactionary exclusion and to adopt a much more deliberative, transparent approach.
They felt the process was too opaque.
It was undeniably terse. The consultation gave very little explanation as to which market participants raised these concerns or why, of all numbers, 50% was chosen as the magical cutoff point. Strategy argued that this lack of deliberation is just inappropriate for a rule that could impact billions of dollars and set a global precedent.
And they had a precedent from MSCI's own history to back this up, didn't they?
They did. They pointed to the creation of the communication services sector. Strategy noted that the process for that change, which was also a huge reclassification, took 19 years of evolution and extensive consultation to get right.
19 years.
19 years. And they argue that should be the bare minimum standard for handling a classification change that's trying to define and restrict an entire budding industry like DATs. This requires careful thought, not a rushed rule change.
Okay, let's step back from the arguments for a moment and really focus on the practical implications for our listeners, especially those who might have exposure through the preferred stock, STRC. If Strategy's main stock, MSTR, gets delisted or hammered by this exclusion, is it the kill switch for those preferred shareholders? Is the fortress immediately breached?
Based on all the source material and the financial architecture they've built, the clear answer is no, it is not an immediate kill switch for STRC holders. But, and this is a very big but, it absolutely exposes a critical, fundamental long-term vulnerability that you just cannot ignore.
Okay, so let's look at the defenses first. Why is the strategy fortress secure in the medium term, even if it's facing this immediate $2.8 billion selling pressure on the common stock?
The sources confirm that the STRC preferred stock is engineered specifically for principal stability and high yield. Its security in the medium term is guaranteed by a massive financial cushion, a firewall, which is a $1.44 billion USD reserve.
The cash fortress we've talked about, let's anchor that metaphor with hard numbers.
Yeah.
What does that reserve actually buy them in terms of time?
According to their latest filings, that reserve provides a guaranteed 21-month cushion for all of their preferred dividends and their debt interest payments. And this isn't collateralized Bitcoin. This is liquid US dollars held specifically to absorb market shocks.
So even if that $2.8 billion selling wave hits MSTR tomorrow, the Bitcoin price crashes at the same time, that cash reserve ensures the company can avoid forced Bitcoin sales for almost 2 years.
For almost 2 years, just to serve as the preferred dividends and debt. And that's the difference between an immediate solvency crisis and a long-term liquidity challenge.
Right. And STRC holders also have seniority, don't they?
They do. They benefit from structural seniority in the liquidation waterfall compared to the common shareholders. This protection is baked right into the senior debt covenants in their public filings. Strategy has confirmed this structure protects the principal, even in a catastrophic 82.8% Bitcoin drawdown from its highs.
So the common equity absorbs the vast majority of the initial losses, protecting the principal of the preferred shares.
Exactly. Which is why it is not an immediate kill switch. The structure is designed to buy them time.
But the sources are very clear. This is a fundamental long-term threat. This is where the engine breaks, because that fortress can't sustain itself forever.
This is the absolute crux of the long-term vulnerability. That estimated billion-dollar outflow from the MSTR exclusion would severely impair the company's ability to execute its funding model. It breaks the mechanism that refills the cash reserve.
So let's remind the listeners about that funding model, the ATM arbitrage, and its reliance on the MSTR premium.
The whole digital credit structure, their whole machine, relies on selling MSTR common stock at that premium valuation to the underlying Bitcoin. That premium is essential. It's what provides the cheap external capital they need to perpetually replenish the USD reserve.
So if MSTR gets delisted from major indexes, or if the sheer volume of passive selling from this MSCI rule causes that premium to just collapse or disappear,
Then the engine that refills the cash reserve breaks down. The ability to fund the fortress is compromised.
and that leads to the ultimate vulnerability. What happens if a sustained market downturn lasts longer than that 21-month reserve, and their ability to raise new equity is gone?
Then the corporate risk disclosures confirm that the last failsafe comes into play.
And that last failsafe is the one scenario Strategy Inc. was basically founded to avoid. It's a direct contradiction of their core philosophy.
Yes, exactly. The forced sale of Bitcoin to satisfy financial obligations. While the cumulative feature of the preferred stock means STRC holders will eventually get paid, the process of liquidating the core treasury asset to cover those payments would compromise the entire mission. It would likely mean realizing massive capital losses, and it would effectively turn the company into a liquidating entity.
So, to sum it up, the MSCI exclusion is not an explosive trigger that destroys the company overnight, thanks to that 2-year cash cushion, but it is, as the sources defined it, an acid test of the entire financial fortress.
It gives strategy roughly 2 years, that 21-month cushion, to either successfully fight the rule or to find a new scalable funding mechanism outside of the passive index world. If they can't restore that long-term access to capital, the preferred stock, despite its seniority, would eventually rely on the liquidation of the digital treasury.
The very outcome the cash reserve was supposed to prevent.
It transforms a growth company into a defensive one fighting for its life.
So this is where we need to step back and look at the broader implications. What we're watching here is not just a fight over one company's stock listing or a debate about accounting rules.
No, it's a proxy war for the future of finance and the balance of power. It's a confrontation over the right of the old guard institutions like MSCI that have set the rules for decades to determine which new technologies are legitimate enough for inclusion in these global indices that influence trillions of dollars.
And MSCI is setting a standard that could affect this entire nascent industry of DATs all over the world. The outcome of this consultation will set the precedent for every other company looking to build a digital asset treasury.
The question is, will the gatekeepers adapt and allow their indices to neutrally reflect this evolution in the markets? Or will they build regulatory walls to stifle this innovation just because it doesn't fit into their old, neat classification boxes?
The stakes are enormous for the whole digital asset ecosystem. If DATs are permanently classified as investment funds, they are shut out of trillions in passive investment capital. That severely limits their growth potential and their ability to compete with traditional financial firms that aren't subject to the same rules.
And this is where we remind you, the listener, that this really is a community effort. The analysis in this deep dive is based on publicly available information, especially Strategy's own detailed rebuttal letter, but this story is still very much unfolding.
It is, and Strategy Inc. has explicitly called for broad community engagement. They see this as a battle for the legitimacy of the entire digital asset space, not just their own company. They've launched a dedicated webpage detailing the threat, and we'll link that directly in the description below. They are asking for support.
Your voice matters in this consultation. Specific actions can be taken. We encourage listeners who agree with Strategy's position to email MSCI directly with feedback, to register for support on financial advocacy platforms, or even just to share this information on social media to raise awareness about the discriminatory nature of this 50% threshold.
Every click, every share, every piece of feedback counts in this battle for the rights of a budding industry that is, at its core, fighting for financial inclusion and technological recognition. This is a foundational moment.
It truly is.
And we also invite you, our listeners, to share your own analysis and sources in the comments below. Are we being too optimistic about the 21-month cushion of Strategy's fortress? Or maybe too critical of MSCI's rationale, given their duty to passive investors? We want to hear from you. We are always looking for collaborators to review our content and bring new insights to the table.
So we'll leave you with the core choice facing MSCI, as Strategy Inc. itself articulated it. To succumb to the reactive short-sightedness that established institutions sometimes show towards foundational innovation, or to allow its indices to reflect neutrally and faithfully the next era of financial technology.
That is the decision facing the index provider. Will they be a neutral mirror of the evolving market or an active arbiter setting the boundaries for the next generation of financial pioneers? The world is watching the results of this unprecedented consultation.
Thank you for joining us for the deep dive. We will continue to track this high-stakes battle and provide updates as soon as MSCI makes its final call.
We encourage you to subscribe and share so we can keep bringing you this level of detail. Until next time.